What I want to talk about today is what a whole life insurance policy should and should not look like. And this is specifically focusing on the cash value benefit, which most people we work with have a laser focus on the cash value. The death benefit is important, but the question always is how do I maximize the cash value? So when it comes to traditional whole life insurance, this is what I want to start with, because when you look at whole life insurance sales in general, it's a little over 90% of policies sold are just basic old school whole life insurance policies. And really what that means is, let's pretend that you're in the market for a life insurance policy and you hear some good things about whole life insurance. You probably hear some bad things too, but you say, okay, let me get some quotes for a whole life insurance policy because the death benefit will last for my whole life, because it does. It's a permanent policy. If I were to take a traditional whole life insurance policy, let's assume that it is $1 million. That is the death benefit, meaning if you die, the death benefit is paid out to your beneficiaries, 100% income tax-free. I would look at that policy, and depending on my age, I would have a premium that might range anywhere between $15,000 and it could be well north of $30,000 if I'm older or if I have some health issues. Let's assume I am just about 40 years old. So let's say when I'm 38 years old, because we're going to look at a case study on a 38-year-old individual, and you're looking at a $1 million whole life insurance policy. The average premium might fall right around $20,000, and that is an annual premium. So what a traditional whole life insurance policy will look like in this case is you have a $1 million death benefit, you have a premium of $20,000, and you must pay that premium every year in order to ensure that that $1 million death benefit remain intact. Now, you don't have to pay that premium for your whole life. We'll get into that as we start to look at some examples and actual numbers. But how a basic whole life insurance policy typically works is, if this is you, this 38-year-old individual, 38-year-old male, $20,000 per year, you've got a couple things. One, you do have a death benefit. As you continue to pay the premium, though, you will build cash value. And as that cash value builds, you've got access to that anytime you'd like. So with the cash value, there are a lot of benefits. What people are often attracted to are what I like to refer to as the core benefits. The cash value is a safe, liquid, and a tax-free area to position money. Safe, when I say safe, the net growth rate over the life of the policy typically falls somewhere between 3 to 5%. And that's consistent if things are going very, very well in the stock market and economy, or if things are going very, very poorly. So first core benefit, it's safe. Second core benefit, it is liquid. Whatever I have in cash value, I can access anytime. And I've got a unique loan feature in the sense that anytime I take a loan against the policy, my money continues to compound as if I have not borrowed against it in the first place. A nice illustration is real estate. If I have a piece of property that the fair market value is appreciating by 5% every single year, if I take a line of credit against that property, I continue to receive the 5% on my entire property value. Life insurance works very similar to that. And then I've got the tax-free piece. The cash value can be accessed completely tax-free if I do not trigger a taxable event. So there's a lot of benefits here to the cash value, and what I just mentioned often attracts people. So let's just call it CV for the sake of simplicity, cash value. The issue with it is this, and this is often why people do not purchase traditional whole life insurance policies, is because in the first year, you pay that $20,000 premium in this particular example, and the cash value that you see on the illustration, you see on your annual statement, money that you have access to, is often that. So I have to pay $20,000, and if I die, a $1 million death benefit is paid out. But if I don't die, I literally have nothing to show for that $20,000. It's gone. And this is where the argument of term insurance comes up, where for a 38-year-old male, I can take that $20,000, get a $1 million death benefit, and that can be a 30-year term. Not for $20,000 per year, but breaking that $20,000 up over 30 years. It might be a 20 or 30-year term, depending on the company and its health. But my point is, I can get a much, much lower premium with a term policy when I'm purely shopping life insurance. So with this example, if he continues to pay money into the policy the second year, And maybe you've seen this before with a traditional whole life insurance policy. You pay in $20,000 again and you have zero, or maybe it's a couple $1,000s. But as you continuously pay this premium year in and year out, you might see by the 10th year, you've paid in $200,000 and you have very close to $200,000, still a little bit less. So just repeat what I just said, or I'll repeat it. You paid in $20,000 per year for 10 years. That's a total of $200,000 you've paid out of pocket. If you die, a $1 million death benefit is paid out. But when you look at your cash value, you don't even have $200,000 after 10 years. 10 years to not even get your money back, meaning if you cashed it out, you would take a loss at that point in time. That's a long time to have a negative return on cash value. We don't start to see a gain until after 10 years, and this is typically with a traditional old school whole life insurance product, which is what most people are exposed to or have seen when it comes to whole life insurance. Now, before we just jump to the example, what I want to point out is a couple things. Is you will see different products available. And some different products you might see. One is a traditional, let's call it Life 100 product. If you see this name, Life 100, what that means is that you can make premium payments, or I should rephrase, premiums are due up until the age of 100. So literally, if you pay into that policy as long as you can, it'll be until you're 100 years old. Now, most people don't do that. They don't pay into it that long. You don't have to. There are ways you can easily stop earlier, which we've got other videos on, and I can go through that in detail as well. But Whole Life 100, or L100, means you can pay into it up until the age 100. Same would be true of an L65. Guess how long you can pay into it? Up until the age of 65. Then you'll have products such as a 20 pay, perhaps a 10 pay, and you can even find some products that are a 5 pay. Now, if all things were equal, when I say equal, the death benefit, if you said, okay, I am going to shop for a life insurance policy. I don't like the idea of a paid up at age 100 policy. I don't have to keep making premium payments until I'm 100. 20 years sounds great. 10 years sounds fantastic. What does it look like if I take this $1 million death benefit out? Well, what you will find is the longer the premium is payable, a Whole Life 100, instead of $20,000, the actual premium, in this case, may only be $14,000. So this is often how people will shop whole life insurance, or how they are shown different options. I can take a Whole Life 100 and pay a premium of $14,000 per year. If I want a policy that I don't have to make any more payments until age 65, well, now my premium might be $23,000, closer to 21. If it's a 20 pay, now I'm getting closer to $25,000 per year. And over here, maybe I'm at $35,000 per year. My point is, the longer the funding period, because a 10 pay, premiums are only due for 10 years. After 10 years, I cannot pay anything into it even if I wanted to. The shorter the funding period, the higher the premium is for that same death benefit. And this is just traditional, old school whole life insurance, often how it's shopped and often how people are shown different options. So let's take a look at some options here of the traditional type of product, and then we'll show you how to really engineer a policy or design it appropriately so we can throw this approach out the window and really juice the cash value. So if we pull up an illustration, here's a company a lot of people are familiar with, New York, New York. We've got New York Life here, 38-year-old individual, $1 million policy, premium paying period 20 years. So this is effectively a 20 pay period. After 20 years, he cannot pay into it, even if he wanted to. So let me shrink it down to one page. There we go. We've got the guaranteed and non-guaranteed values. Non-guaranteed assumes the current dividend interest rate is applied. And here we go. So at the end of the first year, he started at 38. At the end of the first year, now he's 39. We see his premium payment, $23,500 per year. Guaranteed cash surrender value. This is the cash value he has access to. What is it in the first year? Not that attractive at all. He's got 0. If we look at the non-guaranteed values, which assume the company's present dividend interest rate, 23.5 is the premium, 0 in cash value, although he does have a $1 million death benefit. So this was a policy that was price quoted for $1 million of life insurance, in which the insured only has to pay into it for 20 years. The annual premium is $23,500 per year. Over a span of 20 years comes out to a total of $470,000. Now, if we look at the non-guaranteed values, which will look better here, better than the guarantees, what do you notice here by year 10? You've paid in a total of what? 23.5 times 10 is $235,000, and you do not have that. You've got $232,000. If we back up, I kind of skipped over the second year, I wish I didn't. Year 2, you pay in 23.5 again. You went from 0 to 6,300. So it's not growing by much at all in the first couple of years. That's a lot of money to pay for a life insurance policy where if life happens and I can't make payments, I'm in trouble, where the policy can lapse and I can potentially lose the money I've paid in. But even if I don't, it's a long time here, going back to year 10, just to get my money back. By year 11, he's finally positive, where he has more money in cash value than what he's paid into the policy. His death benefit has also appreciated. Now, what you'll notice here, whenever you're looking at a life insurance illustration, if you're new to whole life insurance, the death benefit here, $1 million on the guaranteed side. So he does have this death benefit that is guaranteed to remain at $1 million forever. Even after he's done paying into it, after 20 years, he does not pay a penny into the policy. Why the guaranteed death benefit does not increase and the non-guaranteed death benefit does increase has to do with dividends. So if you have a life insurance policy and dividends are being added to your policy, that'll often purchase you what is referred to as paid up additions. It buys you paid up additional life insurance. Paid up because once the dividend is reinvested into your contract, into the cash value, I see it in cash value, and it purchases me paid up life insurance because there's no recurring premium for it. Fun thing is you can actually add money to PUAs on your own, which accelerate the cash value. We'll hit on that as we progress through this video. So in this case, let's go down to year 20. He's paid in a total of how much? $470,000 over 20 years, and he's got $652 to show for it. So not really attractive at all. It took a long time to see any real value there. And we can scroll down. One nice thing about this, as we look at it here, years pass, cash value continues to appreciate along with the death benefit, and he pays nothing in. That's the nice feature about it. But it's quite expensive, $23,500 per year. So going back to the whiteboard, that was a 20 pay. Here we pegged it at 25K per year. But what do we see as we look to the left? If he selects a policy that he can pay into it up until age 100, well, he can save quite a bit on the annual cash flow, $14,000 per year, but now have to pay into it for a longer period of time. Or he can condense his funding down to a 10 pay, funding it just for 10 years. And to be very, very clear, we don't recommend these types of policies. This is just education on how whole life insurance works with the different types of products and often what people are shown when they're shopping just for a basic whole life insurance policy, or usually for life insurance, and then the agent whips out whole life insurance. So let's look at a comparison here. Not that one. This guy right here, beginning with the left. So as we look at this guy on the left, here's a whole life 100, which means premiums are payable up until age 100. And the premium in this example, $14,550. Example immediately to the right of it, we see a whole life 65, which means premiums are due how long? Up until the age of 65. Because I have a shorter premium period and we purchased the same $1 million death benefit, what happened to the premium commitment? It was $14,000 and change. Now it's close to $22,000. Shorter funding period, higher the premium. Over here, here's the option we just looked at. New York Life 20 pay, premium $23,500 per year. And then we have an L99 policy, which means premiums are due up until age 99. And there's my premium, $16,000 and change. All price quoting, $1 million death benefit. And again, transparency, great example here of what not to do if you are interested in a high cash value policy. So what's neat about this is we see that the longer the funding period is, example on the left, the lower the premium, and we also don't have to pay into it up until age 100. So here we stopped altogether after 20 years. He pays zero in, his cash value continues to grow along with his death benefit. And you'll see that's the case with each of the examples here as we scroll down. Continues to appreciate. There we go at year 40. And we have different values, but we've paid different dollar amounts in. So this is not, in my opinion, this is not a fair comparison when comparing the cash values, because example on the left, we paid in $290,000, we got $927, we got $1.4 million in death benefit. This next example, you've got $1.5 million in cash value and $2 million in death benefit, but you've paid in more money, $437,000. And you'll see that pattern continue depending on how long we're paying into the product, or I should say how much we're paying into the product. So let's clean this up and have some fun. When I say clean this up, so this approach, we mentioned we want to throw this out the window because this was an approach someone was shown. They were shown the first three options here, not a 10-pay product. What you can do with the whole life insurance policy, let's clean this up, is instead of price quoting, shopping for the best deal possible, is for the same 38-year-old male, we can target a $1 million death benefit, but when you have a policy, you can actually choose where your money goes. So this is referred to as the policy design. So there are two areas where we can actually direct our money. The fun part is you can choose where you want your money to go, and you can choose how much you want to pay into the policy. Because if we go back to the last approach, where we just price quoted a $1 million death benefit, what happened? Those premiums were high, and he had very little value right out of the gates regarding his cash value. So here, when we actually design a policy, we've got a premium and then PUA rider. PUA stands for paid up additions. When we look at this, let's go over here, death benefit, premium dollars. In the examples you just saw with $1 million, when he paid in $23,500, how much showed up in cash value in the first year? Zero. Whatever that premium is, whether it's $23,000 or $2,300, with most traditional policies, like a whole life 100, we won't see anything show up in cash value in the first year, and sometimes the first and second year. As you continue to make premium payments, you will see cash value build. But why we don't see anything in the beginning is really because the insurance company is overcharging us for the death benefit up front. Then we've got this PUA rider, which is how we accelerate the cash value growth. Money that goes here, guess what? Shows up in cash value. This is money we have access to right away, begins to earn the guaranteed rate, accelerates the overall cash value growth of a life insurance policy. Now, it will purchase you some death benefit. Remember on that illustration on the non-guaranteed side, when we looked at the New York Life illustration, where we saw the death benefit increasing? Why it was increasing is because when dividends were being added to that policy, they were purchasing him, the policyholder, PUAs, paid up additions. When dividends are elected to purchase paid up additions, what happens is first your money goes into cash value, and then it purchases you death benefit. Depending on your age, if $1 goes into PUAs, you might see another $2 to $3 come back in life insurance, an actual death benefit. But here's the fun part. If he's paying in, let's call it $25,000 per year, or if he says that's how much I'd like to pay in, I'm good with that number, and instead of socking it all into the insurance premium, which I would not do, I would do something like this. I'd drive it as low as I could. All companies have different limits here, but we can actually set where our minimum premium is. So let's call it $2,500. And then put the other $22,500 into the PUA rider. And here's the really, really fun part. He doesn't have to commit himself to the full $25K each year. He can easily commit just to the minimum premium and then add additional funds up to a total of $25,000 per year. Whether he hits it or not is completely up to him. We do want to track the performance each year, but a lot of people we work with like to make it very, very flexible. So going back to what we looked at here, so we've got our traditional whole life insurance policies. Let's look at reverse engineering them. So what we'll start with is that New York Life 20-pay policy we had seen, which had the $23,500 premium, zero in cash value in the first year. You've got $1 million death benefit, but it takes a long time to see any real value here. Breaks even between years 10 and 11. Then he stops funding altogether after 20 years. Check this out. So first thing, what we did here was take a whole life insurance policy. HECV stands for high early cash value. Here we go, $25K per year for 20 years. Annual outlay, let's just look at year one. $25,000 goes in, and you're at about $23,000 in cash value. There is a difference here when we look at the death benefit. So instead of $1 million, we designed this with a low death benefit and high cash value. So based on the $25,000 per year going in with this particular product, the lowest death benefit we could have is $600,000. But what's pretty fun about this type of design is we hit the $1 million pretty quickly by year 8. Now, if this is you and you said, I really want that $1 million up front, what I would do is A, add a term insurance rider to this policy, which can inflate the death benefit to $1 million, or take out a separate term policy for about 8 to 10 years, call it a 10-year term. And then by the time that term cancels, you've got $1.2 million here, which is nice. But what do we see differently when we look at the cash value here? Breaking even between years 4 and 5. Cash rich right out of the gates. When we look at year 20, this is not a super fair comparison because we've paid more money in, but we've got $730,000 in cash value. Here we've got an example. This is a different product, a 10-pay policy, but not designed where we pay into it for 10 years, and not designed with a high premium. This is designed with a minimum premium. It's about $10,000, but he's paying in $100,000 per year because it's what he wants to do. He's got almost $90,000 in cash value in the first year, about a $1.5 million death benefit. When we look at the payments, year 2, he pays another $100,000 in. He does not get all of it back. So the first 2 years, those are the worst years of this product. Paid in $100K, took about a $10,000 hit. The next year, he pays in $100K, and he takes about a $3,000 hit, a little bit more. And this is with the policy that's designed for maximum cash value. By the time he hits year 3, though, he gets his $100K back and some. And by the 4th year, he's paid in $400, and he has $400. So he's cash rich right out of the gates and cash rich long term. Here, he stops payments altogether after 5 years, and that cash value just continues to grow along with the death benefit too. Here's another example, $25K per year for 10 years while maintaining a $1 million death benefit. Here we go, breaking even between years 5 and 6 while keeping that $1 million death benefit all the way through, and eventually it did increase. Then you've got one more with $50K per year for 5 years, and then nothing thereafter. Death benefit does drop after the 7th year. And that has to do with the MEC testing on a policy, which has to do with a taxable line, making sure we can access the cash value tax-free all the way through. So hope you enjoyed this video. If you'd like more specific details, I would check out any of our videos on our YouTube channel under the Essentials tab. As far as policy design, how whole life insurance works, they provide a lot more details specifically around how to maximize the cash value. In this video, I mainly wanted to cover what a lot of people are exposed to when they're looking at whole life insurance, and then how we can craft that policy from a bad one into a very attractive one, or making it as attractive as it can possibly be. So I hope you enjoyed this. Let us know if you have any questions, and we'll talk to you soon. Enjoy. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.